Charge going up, fire in the hole. Go. 1. Left clear, servers on the right, main floor clear, moving deeper.
Room secure.
Left. Multiple terminals, all live. Drives in, pulling the data now. Package secured, moving out.
In this lesson, we're going to talk about two critical concepts that every futures trader must understand: margin and leverage. Futures trading allows you to control a large amount of capital with a relatively small amount of money, and that's what makes it powerful but also dangerous if you don't manage it correctly. Let's start with margin. Margin is the minimum amount of money your broker requires for you to open and maintain a position. Think of it as a security deposit. It's not a fee, it's collateral that ensures you can cover potential losses. There are two types of margin you'll encounter: initial margin and maintenance margin. The initial margin is what you need to open the trade. The maintenance margin is what you must keep in your account to hold that position. If your equity falls below the maintenance margin, your broker will issue a margin call and may automatically close your trades. Many brokers also offer day trading margin, which is a reduced margin requirement for intraday positions. For example, some brokers let you trade one contract of NQ or YM with just $500 of margin during regular market hours. But if you want to hold that position overnight, the full CME margin applies, often $10,000 to $12,000 per contract. Now let's connect this to leverage. Leverage is what makes futures trading so efficient. It allows you to control a large notional value with a small amount of capital. For example, one NQ contract at a price of $15,500 represents roughly $15,500 multiplied by $20. That's a notional value of about $310,000. If your broker only requires $500 of day trading margin, you're controlling over $300,000 of exposure with just $500. That's leverage of more than 600 to 1. This is what gives traders the ability to make significant gains on small moves, but it's also what causes accounts to blow up quickly. A 20-point move against you on NQ equals $400 of loss per contract. If you only had a $1,000 account, that's almost half your balance gone in one trade. The rule here is simple. Leverage amplifies both gains and losses. Treat it like a loaded weapon, powerful, but requiring discipline and control. As a professional, you must always think in terms of risk per trade, not just the margin requirement. Use margin as a tool, not a crutch. If you ever need more margin to justify your position is too large. Margin and leverage are the engines that make futures trading work, but they're also the number one reason traders fail. Respect the math, understand your exposure, and size every trade based on your account's true risk tolerance, not its maximum leverage. In the next lesson, we'll talk about ticks, points, and how to calculate the exact dollar value of every movement so you can plan your trades with precision.